What's going on, everybody? Welcome back to the Stock Market Brief Show. Whoa, what a day. We continued to see that rip your face off rally. Started off the trading session early in the morning where my eyes were basically bleeding because of how bright the screen was. A little bit later into the day, my head started to hurt because of all the confusion. And then by the end of the day, my chest basically exploded. However, if you were paying attention to key levels, it wasn't that big of an issue. The market closed well within what the market expected as far as risk. So in today's Stock Market Brief Show, we're going to be talking once again about what those levels of risk that the market's pricing in right now. We're going to look even at the expected moves for the week and see where the big Mag 7 stocks lie within that. And we're just going to try to help overall kind of manage emotions and find some potential trade setups here from the shorter time frame on this market brief, which is brought to you by my partners here, Interactive Brokers. If you want to take a look at what they've got to offer, make sure to check the pinned comment. And even if you don't have an account with them, make sure to check out their campus because they offer a bunch of free resources and free tools, including courses from beginner to advanced. And a big thanks out to my patron community that support me for the $9 a month. And you can also buy annually. It ends up being $90 and you get a little bit of a discount. You get into the Discord, right? A lot of people don't understand this right out of the gate, but you get the Discord benefits, which is all of this stuff on this tier. But in order to get these, you have to sync Discord up to Patreon. You get all these stuff, including the comprehensive set of tradie ticks, bots, and the query channel where you can type in all these type of commands, get all kinds of cool data. We give daily, weekly, monthly, quarterly expected moves, and a whole host of other things. Let's get into today's show. Ring, ring, margins calling. You get a margin call. You get a margin call. Everyone gets a margin call. We got some more tariff news. China said that they vowed to fight to the end. And, well, clearly the markets didn't really like it. 11 sectors were down. Everything else was in the red after seeing a good start to the day. The Fed Watch tool is starting to price in probabilities of deeper cuts. You can see that we were right at around this 325 to 350 to the end of the year. But now the probabilities of getting to 300 and 325 are actually increasing. So, well, when's the printer coming here, Jerome? I found this to be interesting. We've been having some people post this out on the Discord. And this is a Bookmap. I use Bookmap. Some people in the Discord use Bookmap. This is a pretty darn large order down here, but it's very, very, very far away. So it's an ominous sign. I'm bringing this up not to say, hey, this is what's going to happen. But for whatever reason, if we get down there, we're going to revisit this because the longer these stay down here, the more they can act as a potential magnet, right? If we don't have a bid in the market, price tries to navigate to where there can be buyers, right? Big buyers. Well, 43.25 has 6,600 contracts. That's not small by any means, and it's been there for a few days from my understanding. What would that look like on ES? That'd be looking like it'd be breaking down into this range over here, this gray zone, which is, well off of where we currently are. So that's going to be an interesting level if price starts to make its way down there. Now, overall, if we look at the SPX, you can see this level that was prior resistance, and then this that was prior support, this trend line connecting multiple points. Price has shot and came right into that area, and we saw ourselves a little bit of a bounce with some really wide range candles. This is normal stuff, especially when you start to look at the aspects of volatility. But what would that actually entail if we do start breaking down? Well, I guess we can pay attention to these type of levels there. And then also levels like the JPM collar, the lower end down here would be 44.60, which would take us into and around, where's 44.60? Right at about this range right here, which is not as steep as that prior level over here on ES, but still that would be some massive downside. Now, why are we seeing all of this volatility? Well, we've been under the gamma flip line for how many days? 34, 35 trading days. Since February 21st, we've been under the gamma flip line, which is basically right in about this first big down day right over here. So when you go into negative gamma territory, selling, you can sell off faster, right? Selling begets selling, buying begets buying. You could get your face-ripping rallies, which it doesn't look like one right here by any means. But from this low, which was a daily expected move, to this high, I mean, that's a face-ripping rally, believe it or not, on intraday charts. Now, as you're in these negative gamma areas, volatility typically increases. And I always love it right when we go into negative gamma to be much more cautious in the environment because there's a higher probability that volatility rises. In fact, you can see the times that we're in negative gamma, I highlighted them in gray squares. Where it starts is where we get under the flip line. Where it closes off is when we get back above it. And you can see we've spiked up. The most recent big spike in the VIX happened in July into August, but then into mid-July, it gave us the warnings that, hey, we could potentially see something happen. And I always like to align that with some of the big picture charts to give us context to know, hey, should we be taking this seriously now? And we'll re-dive into the big picture charts and the bottom signals in today's video just to give a quick update there. If we take a look at the curve for VIX futures, we are still in backwardation, which means what? It means we got problems here and now, and not so much into the further out looking future. You want this to look like that. It does not look like that. All this VIX and volatility moves made me think about this older chart that I posted on X. I posted this on X in about a few months into 2024. And what I was calling out, right? Believe it or not, a lot of people say you don't do technical analysis on the VIX, and I get that, but every asset, and even in these kind of calculations, they move between periods of contraction and expansion. So what I was pointing out here on these lines down here was how just contracted these Bollinger Bands were from a weekly perspective. In fact, when I pointed it out, we haven't seen this type of contraction since 2007, early 2007. And I kind of highlighted it because I was like, we typically see a pop in volatility, right? And we saw the pop in volatility, and then it came off and did these 3 spikes. And then I'm looking, I'm like, holy moly, we came up, we did these 3 spikes. We started to come back in, and then bam, we saw some big volatility. And it was almost like the same playbook taking place from a contraction standpoint. I found that to be interesting. Can you do anything with that? Nah, maybe not, but nonetheless, it's pretty cool. If we take a look at back month versus front month volatility, still extended down here to the downside, which means what? Well, we're in volatile times, we're getting choppy moves, but you typically try to find some sort of a bounce, look for some extended signals, you play some key levels, and you manage risk as you see fit. This thing over here is the volatility of volatility. And I'm dating back as far as I got as far as data, going back to 2007. And this thing is off the charts. So needless to say, people are in a panic over here. And you can see we're at about 170. The last time they were here was at about August of last year when we saw that big spike in volatility. And prior to that was the pandemic. This was Volmageddon, I believe it was called, or the Christmas Eve massacre. And you had some global growth scares over here in 2015, 2016 area. And then you had all types of stuff. I think this was Operation Twist. I might be getting my dates wrong. And then even over here is the financial crisis. So this is a very, very aggressive reading there. And what does this all mean? It means that the market is very volatile. And I don't need to tell you that other than just show you the proof here in the pudding, and that's looking at what the market's expectations are for risk just going into tomorrow. So once again, these are the largest daily expected moves that I've seen basically, right? This isn't the largest one, but they're in the highest percentile of largest expected moves. Tomorrow's expectation is $181 in the S&P 500. That's plus or minus. These are the levels over here. These are something that I share with my Discord community. So screenshot it and put the levels on your chart. And we can talk through it a little bit in the expected move section. SPY itself, $18. The Qs, $15. Anytime you have the SPY expected move larger than the Qs, it's been in really turbulent times that we notice. I'm going to go ahead and give you the daily expected moves for the Mag 7 stocks here too as well. This is not just based off of the options chain. This is more based off of a calculation pulling from implied volatility that I have put together, and it's giving you the upper and lower levels of risk expectations for these larger products. So we're under the flip line. We're below a bunch of declining 5-day moving averages so far. So either you're trying to prove the market that you're right by buying the dip, or you're waiting for the market to prove itself to feel more confident about getting back in. So when it's like this, when we're below a gamma flip line, when we're below declining 5-day moving averages, typically what I do is shorter term, smaller positions. When opportunities arise, I'll take them. I trade much more from an intraday perspective in these conditions. And I try to take shots every once in a while on swing trades if it makes sense. But the positions, once again, could be I could start a bunch of positions, but they're all typically pretty small for the most part and a little bit wider stops. As this has all been playing out so far, just take a look at some of these extravagant moves in commodity space. Look at copper. This is a 50-year chart of copper. This I posted on Twitter the other day, or on X the other day. I was showing off the 3-day rate of change. It was down 16.95%. I was like, because it was selling off like crazy. I'm like, when's the last time this happened? It hasn't happened. This is dating back 50 years. This is to 76. The time that we were down here, the most closest in 3 days was the great financial crisis. In fact, I said, okay, well, today it sold off again too. So let's put 4-day rate of change, minus 17.79%. You can see over here, boom, when's the last time it happened? When's the only other time it happened? It was during the great financial crisis. So these moves in commodity spaces are just mind-blowing, right? Look at the 10-year yield snapping back rather aggressively. This is kind of interesting to me, right? As this is aggressively snapping back, bonds, right? Typically, the flight to safety are coming in. There's some news that China's selling and yada, 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 but we saw an aggressive move up. We're seeing aggressive move down. Bond volatility is obviously increasing during these times, but what I find so interesting about this dynamic taking place right now was oil was actually down on the day. And typically, oil and yields, right? The treasury yield, they kind of move hand in hand. So this is going up, oil is going down, and oil is a good barometer of kind of a leading indicator on yield. So you can actually see that here where the black line is oil, the candlesticks are the 10-year, but notice how we bottomed over here in September. We ripped up higher, yields kept on going down, and then shortly thereafter it followed. And you can see they peak out right around the same time and so forth. So right now they're kind of diverging from one another. So who's the liar over here? I would imagine that it's technically oil, but this could be a shift in intermarket aspects. We'll see how this one plays out. But being as we just saw, oil coming off and the bonds coming in, right? Given there's a lot of geopolitical risk too, but bonds, maybe even from the shorter end, can be setting up for a buy the dip opportunity. So we'll keep an eye on that. Let's take a look at some of the longer term bottom signals. I got 2 of them here. These are the ones that I shared on the prior video. I wanted to do an update. The reason why I'm doing an update is because they actually kind of got a little bit more frothy to the downside, but by no means are they actually giving us that bigger bottom signal yet. You want to get under 20, then you want to burst back above that 35 over there to 40. And then over here, the NASDAQ Cohen high low, you need a weekly close down here. It did start to come off a little bit more for this week so far, but we're still well off of this. And it's just surprising to me after seeing some aggressive sell side in these markets that these aren't actually all that frothy to the downside. So it is what it is. Let's take a look at some of the bigger picture charts, give some updates there. The 10-year 3-month yield curve is starting to uninvert once again. If these start to steepen, right? Take a look back through history. When we start to cut rates, right? These start to uninvert, and we've ran into some turbulent times, some volatile times, and the Fed typically has to step in and do something. So what's the worst case scenario? Well, we get a bigger type of event to occur in the midst of all of what we've been seeing in these volatile times. What that looks like, I don't know. Is it a credit event? Is it something else? Or is there nothing and this is just a wash? Once again, I don't know, but we've been showing this chart for a long time as we've been inverted and we started revisiting it, right? As we started to steepen through here. Because looking back through history, it's an important note. If you take a look at the yields, the 10-year, 2-year yield curve, you can just see that this thing kind of ripped up today too as well. So I was showing the 10-year, 3-month on the other charts. I just wanted to revisit that 10-year, 2-year, which is kind of that a more popular one, but the 10-year 3-month has been known to be the Fed staple. If you take a look at IWM on the weekly time frame, volatility still holding up rather high over here. And then the same story goes when you look at the Fed funds and the yield curve. And as IWM's coming in, we're keeping a close eye here on that lower trend line, which I'm going to have to get the more closer exact levels, but we're about $10 to $15 off of that. If you take a look over here on the IWM monthly chart, we're pulling into and around that area, believe it or not. We're down 12.37% on the month so far. So these are by no means small moves in small caps. Take a look at the Dow Jones Global Index. We're still well off this lower trend, and I'm keeping a close eye on this one too because it's in line in confluence not only with these prior tags, but it's also in confluence with the lower Bollinger Band. And what I find interesting too is when we've gotten down into these areas before, there's typically some sort of event or some sort of occurrence that happens, whether that be with the Fed or something else, where we get a bounce from it. So it might be something to continue to pay attention to. We look at the KBW Bank Index, still rejecting off that red zone for whatever reason when we've been up here before. before, right? You can take a look back at this Fed rate curve in the 10-year, 3-month, but every time we gotten up here, for some reason, there's been issues, right? Financial crisis, trade war, pandemic, going into the bear market of 2022, where we had high inflation and a Russia-Ukraine war, and now we're dealing with trade war 2.0, apparently. Then the last one I want to really talk about here on the big picture chart, the CPC put to call ratio. It's not updated for today, but I'd imagine it probably went up a little bit higher. That's the 10-day moving average of the put to call ratio. And it can be a good buy signal when it crosses back below 1, but I'm looking for extended readings up to like 1.2, which we've seen in the past. But while that happens, you typically can get a skew to get crushed, right? Like being down by 115, it doesn't need to quite get down there, but those levels that we've seen in the past, like coming back down into and around this 115, 120 with an elevated 1.2 plus level on the 10-day moving average of the put to call ratio, has marked out capitulatory bottoms both in the pandemic and the 2022 bear market. So it could be worth watching. As far as signal charts go, for a more shorter term perspective, the old fool indicator over here, where you look at the NASDAQ composite and divide that into the total put to call ratio and you apply some moving averages to it. They did cross over here. We talked about it. It's a lagging indicator. Well, this one sold off. We saw a little bit of a bounce, sold off. We saw a little bit of a bounce. We saw it sold off again over here. So as laggy this is, you want to see the green line cross it back above the blue line. That's a 21 EMA versus the 50 EMA. But right now it's pointing straight down and it's kind of showing us the path down further. Now, if we take a look at NASDAQ McClellan oscillator down here, this is finally actually getting a frothy reading. Right on the last episode, we looked at it, I'm like, it's getting down there, but it's still not like that extended. I was surprised to see this move take place into this August low over here, but yet August had a much deeper reading. Well, now finally, after today, we've got a more deeper reading. So it's kind of making a little bit more sense there. If you take a look at the NYSE McClellan oscillator, also finally getting into more of an oversold condition here at minus 90. Let's hop into these expected moves. Okay, so going into tomorrow's trading session, the upper expected move, if the market rips up higher, the place to watch, which is there's a lot of confluence up here, it's 514.82. That's also in line with the lower quarterly expected move. So we're already outside of what the market priced in for the quarter. Clearly, a lot of volatility. That's also in line with the tariff announcement VWAP. Today, we started up and away, right? And then what I was looking for was a potential pullback into it and to see if it can hold and buy some strength through that to go higher. Well, it broke down, so you got to step away. If you trade intraday, right, you can scalp. I did a lot of scalping intraday today, but this one continued to break down. So if you're looking to buy the dip for more of a swing trade, keep an eye on market net flow, and you gotta be patient. So what is it that I'm looking for on a bigger sell-off? I'm still eyeballing the lower weekly implied move. Somebody asked me in the Discord, are you still going to be going pretty heavy if it gets down there? I wanted that to be Monday, and Monday came down to the daily implied move, so I bought some, but I didn't quite go across the board like I wanted to do. And then I sold into it, kept a little bit of runners, sold again into it today, and I was hoping to add back into it, to be quite frank, but I couldn't do it, so we sold off. And now if we come back into the lower daily, lower weekly, I may execute a few things down there, but it's going to be a little bit more hesitation because now at this point, I want to see strength before just buying the dip specifically. And I'm going to have a more focus on these smaller term charts because it's been working out very well for me right now. And then I'm going to start to get back into more of the swing trades slowly but surely when I start to see price firm up just a little bit more, because it's a little bit too crazy right now to do anything from a larger capital standpoint for my personal preference, that is. Okay, now I want to really quickly also mention that the market's expected move for the week is still wide open, right? We're down a little bit on the week, seen a lot of volatility, but the good news here is the market finally is, at least for right now, it's only Tuesday, but it's actually handicapping the risk quite well right now by getting bigger expectations of risk. So that's a positive sign. These last 2 days, they were very large expected moves, but the market did a very good job handicapping that risk. So keep an eye on these expected moves. They've been expanding quite a bit. They've been decent levels to play trades and stuff from if you're doing intraday stuff and execute from, but you got to be just very cautious given the context of everything. I see right now the market kind of off in the after market session and the futures market. I'm going to wait for the market to open up. I'm going to give it 15 minutes, 30 minutes of rest, and maybe do some scalps within there earlier if it makes sense. but I need to let this market kind of settle in a little bit, let the dust settle, and then start to see what opens up for a potential opportunity here in the context of all this volatility. Now, if we look at the expected moves for the Mag 7 stocks, how are they doing? Now, I'm going to show you the weekly and some of the monthly expected moves, but Apple, huge sell-off into the week, right? These last 4 trading days or whatever, where did we come to? We came to the lower weekly implied move. We started to hold it. Is it going to crack through that? I don't know. But right now, it just tagged what the market expected. What about Microsoft? Microsoft came into the lower expected move for the month. We actually found strength from it. And today, right, after that big gap up, it sold off. It's still a higher low at this moment. And we have the lower weekly implied move way down here. So it's within its month's expectations and it's within its week's expectations. Take a look at Google. Google hasn't even tagged its lower monthly implied move, and we're well within the weekly implied move there too as well. Amazon's been doodling around its lower monthly implied move as it stands right now. You can see we came up today into the upper weekly implied move, and we started to reject off in just a very algorithmic type sell side action. And then you take a look at Meta. Meta's been where? It's been doodling and hanging on for dear life down here at the lower implied move for the month as well. Where did we start the day today? At the upper weekly implied move, and we had that algorithmic type selling grab holds on Meta. Take a look at Tesla. Tesla slightly down on the week. Have we tagged the lower weekly, lower weekly, lower monthly, and or the lower weekly? And the answer is no. But if we come down here, start to look at about 206 to 207, that's the lower weekly, and that's in confluence with the lower monthly implied move. So once again, it's really volatile. And when things are volatile, which we've been kind of trying to hammer in here, right? You get rip your face off rallies, and you can sell off right after. You can get a massive sell side activity to the downside in the morning. People get all freaked out, and you could potentially capitulate upside, right? It's a very difficult environment, so you got to put FOMO to the side. You need to be patient. You need to trade smaller size if this is not your type of style of trade. And if you're more of an active day trader, these are the type of environments that work really well for those type of people if how to handle this type of volatility. And as far as swing trading goes, why try to prove to the market that you're correct? Let the market prove itself. Let things shape up from a good risk to reward, and approach it as if this is your business to do so. That's all I got. See you later.